The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stocktake. My name is Gaurav Sodhi. Joining me today is editor John Addis. Hello, John.
Morning, Gaurav.
And with us also is analyst Nick Cummings. G'day, Nick.
Morning, Gaurav. Morning, John.
Now, John, I've got an important question for you.
Go on then.
Have you ever heard of a senator threatening a businessman over not knowing his return on equity? Threatening him with jail time, no less.
It does seem a bit excessive, even for the standards of Australian politics. It does seem completely out of order to threaten somebody for jail. I think if any of us were asked that question, I'd definitely need a long time to think about it. You guys probably don't. But the threat of jail certainly wouldn't help me answer it.
What a bizarre situation. I thought we might discuss this a little bit, not necessarily to mock the senator who is, quite clearly financially illiterate, and not necessarily to mock Brad Banducci, who is...
He does a pretty good job of that himself, I think.
Yeah.
Unnecessarily stubborn. Yeah,
it's weird.
Incredible stubbornness.
Yeah.
But I thought we'd have a quick 10-minute chat, well, maybe not 10 minutes, but a quick chat about return on equity, what it is, specifically about Woolworths, whether it's important. And Nick, I think you've got some interesting perspectives about this and whether and when we should look at return on equity. So let's start from the very top. Nick, explain to us, for those who don't know, and perhaps John, what is return on equity?
Return on equity is simply the profits a business makes divided by its shareholders' equity, but there's so many components that come into it. We were talking about, off air about the DuPont analysis, which breaks it down into sort of three baskets, and that looks at the profit margins of a business. So it's profit divided by its revenue, and then the asset turnover of that business. So the revenue divided by its total assets. Finally, its total assets divided by its total equity. But I do think this return on equity, like the senator in this case was trying to say, the banks only make 13% return on equity, 12% return on equity, and Woolies is pretty much price gouging because they make 26% return on equity. But it's just a useless comparison. I think a much better way to look at it is to look on a return on invested capital, and you have to really compare apples with apples and industries with industries because different industries have completely different profit margins and different returns. And I don't think anyone would say that Coles is a better business than Woolworths necessarily, but its return on equity is 31%. It's actually better than Woolworths. So you have to be careful, just comparing just one metric. I mean, we can go and start a business, borrow a ton of debt, and have very little in shareholder equity. And if we make any money, our return on equity could be 100 or 200%. But a business is probably not sustainable, and if a downturn comes along, that debt will be at the end of us. So I think it's important not to just look at one singular metric. And I've generally found return on equity to be a metric I don't look at as much, and I prefer to look at actually return on invested capital, which takes the company's debt into account as well.
Yeah, I've also, as I've matured as an analyst, I've become increasingly skeptical about return on equity, not because a high return on equity is bad necessarily. It's just that it's very easy to manipulate return on equity. I find the DuPont analysis a really clear framework to think about it. So whenever I come across return on equity, I break it up into its three constituent components, which is the return on assets, which is kind of the unlevered return on equity. But profit margins, I guess, is a good proxy for that. You take your margin, and then you take your inventory turn, so how quickly that your inventory turns over in a year, and then you apply your leverage ratio to that. So how much debt do you have in relation to your equity, and that will give you your return on equity figure. But once you break it down into those three parts, you can then say, is your high return on equity coming from high margins, high turnover, or high leverage? And when you're able to pinpoint where exactly it comes from, then you can say something more intelligent about the business. And when we apply that sort of framework to Woolies, Woolies has a low margin, extremely high turnover, and pretty high leverage because of the operating leases it has. It doesn't own its properties; it leases its properties, and those leases are a form of debt. So the business model is high turnover and inherently high leverage. So it's a business model that's going to get you pretty high returns on equity. When you compare that to another retailer that might own its property, the margins might be very high, but most retailers won't have anything like a supermarket's return on equity. And if they've got a big bunch of property on their books, then obviously the return on equity is going to be a lot lower because the asset side of the equation is a lot lower.
Yeah.
A lot higher, rather. So Nick's point about comparing industries is really important. We would certainly never compare return on equity between one industry and another because that makes no sense to do that.
If you were a Green senator, for example, and you didn't want to make a fool of yourself in public, and you had to choose one metric to establish whether a supermarket chain was price gouging or not, which one would you choose?
I would look at margins, actually.
I would agree. You have to look at profit margins. It's the easiest to compare across industries. And, if they were operating at a 40% operating margin and Coles was at 3%, well, obviously.
It's interesting because a few years ago, I think we actually made that case that Woolworths was over-earning. This would have been about a decade ago now, but Woolies was making 8% operating margins against, and I think we wrote an article about this, there's a whole bunch of other international supermarkets making 2 to 3% operating margins. And I think we said at the time that this business is over-earning and margins are at risk. And that's when Aldi came in and forced those supermarkets to lower their margins and become a much more competitive industry. That was also when Coles was a bit of a basket case and Woolies was certainly over-earning. And so the strengthening of Coles has helped the competitive positioning as well. And those margins have rebased now to sort of...
they have come back.
Yeah, which is more in line with international peers.
I used that when I was doing a comparison. I think it was in Outrage Friday. Maybe it was in another story where I did look at supermarkets' operating margins and Woolies had increased. It just seems an obvious metric to use, and it seems weird that politicians are surrounded by advisors and they can't work out which one it is they should ask about. It's also a question that's a lot harder for him to not answer.
Yeah, I think that's maybe the answer there is that's why they didn't ask them about that, is because it actually has got come back to the national standard of that couple of percent. So there's nothing really to make a big political point over there.
Yeah.
It was also, I don't understand why it was a good opportunity for Brad Banducci just to explain calmly and rationally. He could have answered the question and then gone on to explain kind of what we just did about where that ROE comes from. It comes from leverage and from high inventory turn. It does not come from margins. I don't understand his behavior there. It was kind of weird how he was just so stubbornly sticking to. It was so inflexible.
We saw that on Four Corners.
Yeah.
It's clear he hasn't learned much from that episode, and maybe he doesn't need to because he's going to be leaving soon anyway. So
perhaps. Talking to insiders from Woolies, and I know a few people who work there, internally he's very highly regarded. And he's done a good job as a CEO. I think he's an excellent executive. Yeah. It's just strange when you stick a camera in front of him. He seems to lose his mind a little bit.
He does. I don't think you can expect CEOs to be good at everything, though. And the thing that you probably worry least about, I think, from an investment point of view, is their ability to deal with the media.
Yeah, yeah.
In fact, I think it's kind of in some ways, it's an asset. I know that sounds weird, but if you've got somebody who's really, really good at dealing with the media, then they can lead you down a garden path in the way that Banducci really isn't going to lead you down.
Yeah.
That's true.
Yeah. And it's very business specific. Like if you're the CEO of a bank that regularly deals with government, regularly deals with television, those sorts of things, I think you need someone that's quite adept at dealing with the media, particularly in those larger organisations. Like I think I like listening to Jamie Dimon from JP Morgan. I couldn't imagine if him being rolled out if he couldn't speak, like the largest bank in the world. It would be a bit odd, but. Yeah.
There's a lot of star CEOs floating around that could maybe give that a go.
Yes.
Wow.
Former
He's
star
one of them.
CEOs.
That probably deserves its own podcast one day, but what a disaster. That's really up there in AMP proportions, isn't it?
Incredible. Absolutely astonishing.
Complete implosion of a business.
Yeah.
We might save that for another day. But look, just to finalize this point about ROE, Nick, I was interested to hear that you say that you don't even look at it that much anymore. I think for many people who are, that they cling to Buffettisms and Mungerisms, which kind of exalt ROEs, what would you say to those people who quote Munger at you and keep looking at ROEs? I mean, what's the final analysis?
One of the reasons I don't look at them as much is because when I was previously looking at Home Depot and Lowe's in the US home improvement space, essentially these companies had bought back so much stock over the last decade that there was no equity almost left. So, and people go, "Oh, that's really dangerous," but it's not actually when you think about it in practicality. But so those executives there are incentivized on their return on invested capital. I just believe it's just a far more encompassing metric rather than just isolating return on equity, which can be distorted with things like write-offs, and stock buybacks. So that's why I throw back to the Munger and Buffett crowd. Though it's not that I don't ever look at it. If I saw a bank earning 50% return on equity, well, that stands out. That's a bit odd. It's just industry specific, but I do focus more on return on invested capital, which includes the debt. Yeah,
I'm glad you brought that up because that's what I do as well. I like to compare returns against peers in the same or similar industries, and if something is an outlier, then that's worth investigating, trying to understand why is this an outlier. But I would never compare it across industries. And there are some industries, software, for example, which doesn't necessarily have a lot of assets. It's an asset-light business. You ought to expect high ROEs. And there are, for retailers, there are some retailers who own their stores. There's some businesses that own their properties. You'd expect lower ROEs in those businesses as well. So I think it's a way of bringing out nuance in a business, and it's a way that helps you understand the business a little better. It's not an indicator of performance or quality by itself.
No, that's exactly right. I mean, it's not like you run a screen and find the 5 best ROEs on the market, and that's a recipe for success.
Oh, I think I've seen those articles on Livewire. It's amazing how many people actually do that, Nick. I bet more than 50% of investors do exactly that. There's actually a bit of news I wanted to bring to the table as well. This week, we've seen 2 capital raisings announced by 2 data center operators. And I just wanted to spend a few minutes unpacking that. I probably will write something about Macquarie Technology, which is now raising about $100 million. But it's also worth noting that NextDC is raising more than $1 billion of equity. And wow. I think we recently slapped a sell on NextDC, noting that its ambitions to grow were so vast and outrageous, they couldn't possibly be funded with operating cash flow. And I think like a few days later, they launched this mammoth equity raising. And I actually think that was very opportunistic because the share price is, by any measure, higher than it's ever been in terms of relative valuation. And so it makes a lot of sense for them to raise a whole bunch of capital at what is arguably an extended share price. So I think that's really good management to raise capital at these prices, and I'm amazed the discount is not higher. They're raising more than $1 billion to try and fund all this growth. But I'm increasingly getting wary of when we're going to see free cash flows out of NextDC. There just seems to be an endless amount of investment. And at some point, we need to start seeing free cash flows, and I just don't see a path to it. The risks are rising with NextDC as they become more ambitious. They're building different kinds of data centers. They're now building wholesale data centers, which I question whether returns will be as good as traditional data centers. They're going overseas, which is a new risk. I wonder whether returns will be quite as high. And there's a lot of capacity coming online now. So even if they continue building additional centers in Australia, are those centers going to earn the same high rates of return they have in the past? These are all risks. They're not necessarily problems. These are all risks. And because they're doing so much of each, the risks in XDC are rising quite quickly. And
maybe this is hindsight bias, though, but you could make the same kind of argument about Amazon. It was investing in growth and it did it for 20 odd years before it became profitable. I mean, I don't imagine that's a correct parallel, but what is it
that's
about?
That's a great parallel.
Is it?
I can refute that.
What is it about XDC that makes them different to what everybody else is trying to do? Because they're not the only ones doing this, right?
So Amazon, you're right. Amazon for a long time had no profits, no free cash flows. They just invested into their own business, and it fooled a lot of analysts because for about 10 years, it looked as though this was a profitless business. The metrics were all terrible, and it was a really divisive stock around the world. But I think the key to understanding Amazon was that it had built Amazon Web Services, one of the biggest businesses in the world, without any external capital. So it had funded the growth of this enormous giant. And so there was all this cash flow being generated internally that was then being reinvested. So it was showing no cash flow and no profits, but it was showing no free cash flow and no profits. But in fact, there's lots of operating cash flow being generated and being reinvested. It's not quite what's been happening at NextDC. NextDC has had to take on vast amounts of debt, consistently raising equity, and then building new data centers. But those new data centers aren't providing the cash flow for reinvestment. So there's a continual cycle of raising more debt and more equity. Now, a business that continually raises equity is not typically a great long-term investment. It really dilutes shareholders. And I think we are right to question the capital allocation decisions of a business that continuously has to raise equity. Now, probably half a dozen times NextDC has raised equity. It's starting to get a bit too much, and the sums are getting bigger and bigger. And I just think the risks there are rising. Sorry, Nick, you want to say something as well?
Yeah, I was just going to echo those points. That's the real difference here. Amazon's been, I think, self-funded. I think the last time they raised capital was actually 2003. So it's been able to do it, without needing external capital. I was going to ask you too, Gaurav. I don't know NextDC that well, and I know it was an opportune time for them to raise money because the stock price had jumped after their report. But I had a look at the slides and I found it very salesy. They really sold this artificial intelligence, opportunity, which it no doubt is. But this looked a bit, I thought there was a few red flags there.
Yes, I completely agree. I listened to the call, the earnings call for NextDC, and I walked away thinking it sounds as though this is sounding more cultish and more devout than I would have liked. NextDC has always been a proficient sales organization. The guy running it, Craig Scrooge, is an amazing communicator, a wonderful speaker, and a great publicist. And you've needed those qualities because you've had to raise a lot of capital along the way. But this year
he couldn't run Woolworths.
Very different than Brad.
Yes, that's right. But this year it took on a different tone, and that's something that's very hard to convey. It may make me sound a bit wishy-washy, but when you follow a stock from a long time, you can identify when something changes, and something did change this year for me. It certainly became more of a cult and a mission business than it was a rational one. And that heavily influenced my decision to slap a sell on it. And I'm quite comfortable with that call, actually, even though the share price, well, actually, the share price is down since then. But the enthusiasm for the stock has really increased. I'm happy to be out of it.
So you're calling time on the NextDC debt Ponzi, are you?
I'm not sure it's a debt Ponzi. I just think the risks here are just rising way too much for comfort. And if we compare what's happening with Macquarie Technology, it's quite a different scenario. So Macquarie Technology for 20 years raised zero capital, but still built this amazing data center business. And it did that primarily by selling the property and then using those proceeds to reinvest in the data center itself. So unlike NextDC, it doesn't own its own property. It had sold its property off to one buyer, in fact. And the capital raising announced yesterday is for $100 million, 160, I think it is, odd dollars. And the purpose of that is to repurchase all the property from that single PE firm. And my guess is that the PE firms generally have a mandate to hold investments for 3 to 5 years. The opportunity came up, and it makes a lot of sense for a data center business to own its underlying property. There's enough evidence that customers think in decades, not years, when it comes to data centers. So they feel a lot more comfort when the businesses own their underlying property. And it's a point that management made clear yesterday was that it also helps in securing debt finance for future investment. If you own a whole bunch of property, you can get finance at much cheaper terms, far more readily than if you don't own property and have to potentially then raise a lot of equity. It's worth noting that the two brothers who founded and run NextDC own about 50% of the equity, probably just less than that now with this new equity raise. And so they're heavily incentivized to watch that capital allocation very carefully. And the growth hasn't been as spectacular, although I think the returns have been even better in Macquarie than they have in NextDC. They've just watched that balance sheet far more carefully. They've been far more judicious with cap raises. This is only the second capital raising in 20 years. And I think it's done for quite a conservative purpose. It's not raising a whole bunch of money to then reinvest in more growth, which can be a good thing up to a point. They're actually raising money to purchase the underlying property, which I think strengthens the business and, in fact, reduces risk rather than raising it. So I'm a shareholder of Macquarie Technology. I have owned it for years. I'm quite happy to continue holding that. And if there's an opportunity to buy, I'm quite happy to top up. So that's one that will continue to stay on the watch list. Is that one you're familiar with at all, Nick?
No, not really, though. I probably prefer Macquarie just because what you said just there, where they haven't been raising as much capital. Also, I think that probably comes down to that's run by a founder owner.
Absolutely.
As well, and he wants to protect his stake and grow his wealth, I guess, and not incentivized by any short term bonuses or anything like that. So no, it's not one I know well. I did listen to a podcast, probably might have been over a year ago, and it was from Jim Chanos, the famous short seller that
I listened to the same podcast. Yeah.
Yes, that exposed Enron. And he was sort of making the case that data centers were a bit of a commodity business, or were becoming a commodity business. And I haven't really looked into it, but there seems to be a lot. Everyone seems to be rolling out data centers. Goodman's talking about it. They're not actually running them; they're just building them and I think owning the real estate. But it does seem to be a very, very hot space at the moment.
Yeah. I've written a lot about this. There's different kinds of data centers.
Yeah. The
kind of data centers that NextDC runs are called co-location, and they are about providing. I've described this as a shopping center in articles in the past. It's like a Westfield. They provide access to big hyperscalers. Think of hyperscalers like the Woolies, the Coles, the JB Hi-Fis. They provide all the network traffic, and then smaller clients come in and pay much higher rates and benefit from connections to those hyperscalers and with each other. So the co-location data centers are actually a network, and they make money because they're able to provide connection opportunities between everyone inside the data center. And those data centers constitute a network. So the more data centers NextDC rolls out, the larger the network grows, which is why the incentive to roll out DCs is so huge at NextDC, because it strengthens the entire network. Whereas there are US competitors who don't do co-location. They do wholesale, which is they just provide big sheds for Amazon or Facebook or Google. You can imagine that that's a low margin, highly competitive business. So there's, and then someone like Macquarie will do much more service orientated data centers. So they don't charge a lot, and they don't have a huge advantage in getting people into their data centers. They don't provide the same connection opportunities. But once you're in the data center, they offer a whole layer of services. And in fact, the management there says that once a customer is inside a Macquarie data center, the revenue over the next, I think they said 10 years, 10x's per customer, because of all the additional services that tend to be attached on. So it's a different model again. So, I heard that podcast as well, and I think Chanos, you'd never dismiss what he has to say. Incredibly smart guy, and he made some really good points about the US operators, but I'm not sure they apply as well to co-location, and particularly to the service-heavy Macquarie data centers. That's incidentally why I still think there might be an opportunity in Macquarie, because the current valuation is always going to look crazy. It's always going to put people off, because the revenues really compound over time. So every new customer they get, there's a very good chance that customer ends up paying multiples of the revenue, and the margins go up over time. Time is such a great ally of Macquarie. The business gets better and better as time goes on. It's a wonderful compounder, and it's one I think you can comfortably hold for a long time.
Okay, so members can look forward to some research on that.
Yeah, I'll write something up about the cap raise. I think it's an interesting strategy. One that it's a cap raise I had not seen coming. I think it was easy to see NextDC was going to keep raising capital, but I had not anticipated that Macquarie Technology would be raising capital. So yes, that's worth writing about.
Okay,
now, John, let's turn to you. What did you want to talk about today?
I wanted to talk about Ashted, which is my way of introducing Nick's recent research. And the reason why I wanted to talk about it is that when we started, probably 20 odd years ago, Coates Hire was quite a big sort of, I wouldn't call it famous, but it was a well-known company back then. It just seemed very bland, very boring. And not an especially good business either. All its money seemed to go into buying new equipment that would sit on the forecourt of their outlets, and then you get delivered somewhere, and then they would come back, and it was a rental business basically. And it didn't have very good financial metrics. So I was kind of fascinated to read Nick's story on Ashted, which is an equipment rental business, not so dissimilar from Coates Hire, which has gone up, the share price has gone up 250-fold since 2013.
And may I add, I think it's tripled since I took it to the Dragon's Den.
Really?
Yes.
Wow. That's Coates Hire. Seven.
That's Seven Group. Yeah, sorry, that's Seven Group.
Okay.
Yeah. I had to get that in there.
Yeah. Its returns have been better than Amazon and Microsoft. And,
wow. Isn't that amazing?
What on earth is going on here, Nick?
Nick,
what the hell is this? Come on.
Yeah, so I guess the quick story is that Ashted runs through the Sunbelt Rentals brand in the US, and it is essentially Coates Hire. So it rents excavators, forklifts, everything you can think of that would be on a construction site. And while it's an incredibly simple model, it just buys and then rents, actually produces incredible returns. So if they buy $100 worth of assets, they'll rent them out for about $60 a year, typically assets last about 7 years. So they'll earn about $420 on that $100 purchase over 7 years. And then they'll sell it back, either trade it in or sell it on a marketplace for about $35 at the end of that time frame. And then they'll do it again, except this time the equipment will be about 15 to 20% more expensive. And this allows them to actually earn 20% return on invested capital, and that's pretty consistent. Operating margins of 30%. And since coming out of the GFC, operating profits are up about 80-fold. It's just been pretty incredible. And really driving that is, before equipment rental was really a fragmented industry in the US. So Ashtead and its main competitor had around 9% market share combined about a decade ago. They now have close to 30%. So all the market share gains are going to this duopoly, essentially, and there's no reason why they can't have 50 or 60% market share. The reason it goes to consolidates at the top end of the market is pretty much scale. So they can go to the OEMs and demand volume discounts off a Caterpillar or John Deere, and then pass those savings through to their customers in the form of lower daily rental prices. Another advantage is locations. It does, espouse sort of distributor-like qualities similar to Ferguson, where you want to have lots of locations in a metropolitan area, which lowers delivery time. It also makes it easier for the business to service a larger project like a road or something like that, where because this equipment is so large, you can't have it all on the one site. So you need multiple sites around the city to fully service a customer, and only the big two can really do that.
Is this... So I saw the subhead in the research on this, Nick, about an emerging duopoly. Does this really change the dynamics of an industry like this, do you think? Once you have something that is reasonably competitive, that resolves over time into a handful or maybe even only one big player, does that change the finances in a business like this, the metrics in a business like this? Because it seems to have done.
It has done, but I think it's sort of... And maybe we're getting to the end of that where it sort of stops. I don't envision this going from 30% operating margins to say 60% if their market share doubles. But what it does do is create an awful lot of growth where they're just taking more and more market share, and that's allowed Ashtead to grow revenue per year at about 16% compared to the industry at about 4 or 5%. Essentially, This should be a GDP-like, grower, and should decline heavily in a recession. But Ashtead's been able to sort of grow organically by taking more market share, and that's the main feature here, rather than I wouldn't expect from here that the financial metrics change a whole lot.
Okay, does it have a preference for? I mean, is their penetration in particular markets in the US different? I mean, it's called Sunbelt. Are they focused on that region where population is increasing?
That's, I think, the origins of the business. It is a national provider, and customers sort of want a national provider because most of the customers here are actually multinationals and governments. So they want to work with one provider across the whole nation, and United and Sunbelt offer that, so they can sort of play them off each other a little bit. They are definitely... They have less locations sort of on the west than they do in the east, but it's not limited to that sort of Sunbelt, Florida, Georgia region at all.
Okay. So we're waiting for the next crisis then, are we? Even though it's 16 times earnings now.
Yeah, it is. I'd probably prefer to buy this business or recommend this business when the PE skyrockets because earnings have declined. It's 16 times is... I think you could still get a decent return if you're willing to hold through the next cycle and potentially add when that happens. But it really depends. If you're buying today, it really depends on your view of where we are in the economic cycle. It's been a great 10 or 15 years for Ashtead, and whether that maintains is sort of hard to know. I guess, like anything, it's macroeconomic forecasts they're pretty hard to make. So I'd prefer to buy it when it does decline. I will say, though, the business is better than it was in the GFC. So this isn't as cyclical, I don't think, as the market probably thinks it is. So they had about 60% exposure to construction work in the GFC. That's now 40%. The remainder is responding to natural disasters, maintenance and repair work, and events like concerts. And that's much more sticky revenue. So it is a better business now than it was. The other feature here, which is not typical of a cyclical business, is even though revenues declined 30% in the GFC, the company didn't need to raise capital at all. And they didn't need to raise capital in the pandemic either. And that's because they produce counter-cyclical cash flows. So when a downturn comes along, management ceases all new equipment purchases. So let's keep their existing fleet going and replace that existing fleet. So the growth capex, essentially goes to naught. And that cash flow comes in when the company needs it most, and they can avoid a dilutive capital raise. And that's really what actually ends up killing the returns of cyclical businesses that survive. It's not so much that earnings created; it's just when they come back, now the capital base is on, or the share count has doubled, and those earnings aren't worth as much. Whereas that doesn't happen with Ashtead. Or hasn't happened with Ashtead, I should say. Who knows what will happen in the future.
Why is it listed in the UK?
It was originally, so it started, Ashtead is actually, I'm not sure if you've been there, John, is I think a small village in Surrey.
It is, yeah.
Yeah. So
I didn't realise it was related to that place. Yeah.
Yeah, so that's where it started. I think it went public in 1986, I believe, or maybe 84.
Wow.
They sort of wound up 5 or 6 mum and dad operations and took this company public in the UK. And then they made a massive acquisition in the late 90s of Sunbelt Rentals. And that's where the growth has come from over the last sort of 2 decades. So North America, well, the US is 90% of group profits, and then the UK and Canada make up the rest. So it's very much an American business, but that's the heritage is in the UK. And there has been a few UK companies like Ferguson that have transitioned their listing from the UK to New York.
Yeah.
The main reason they're doing that, though, is because the valuations for peers on the US market is higher, whereas Ashtead trades in line with United Rentals. So there's no
arbitrage there.
Yeah, there's no arbitrage there.
What an extraordinary business. I'm glad you brought up that comparison with Coates, because that's a company, when I looked at it for Seven Group, it really knocked my socks off. I kind of expected Westtrac. I think everyone knows Westtrac is a very high quality business. And some interesting insights about that. I think it's a better business than what most people think, but it was really Coates that astounded me. They make consistent returns on capital of over 20%. And I didn't quite understand how that was. I've looked at a lot of these equipment hire businesses in the mining industry, and they're arguably subscale there. And what tends to happen is if rental rates get too high, customers will end up just buying the equipment rather than leasing it. And so there's always a cap on how much you can charge, and hence how much money you can earn on a particular piece of equipment. And that might be different for the kind of equipment that Coates and Ashtead deal with, because they are so big and bulky, and they require more expertise to run, more money to maintain, and so it probably makes more sense to lease them, and the temptation to just buy the equipment is lower as well.
Yeah,
I like the way the key insight, I think, was to think about these as part distribution, part leasing businesses, and I think that's a really good insight, because as a distribution business, you can probably earn more money, and you'd pay more money for it rather than just an outright leasing business. It's a very interesting insight.
Good work, Nick.
Yeah, good work. I think that was really interesting. It has some implications for Coates as well. I think that's probably I couldn't quite understand why that was earning such high rates of return, but I think I have a better idea of it now. So it's been very useful. Right, gents. I've got 2 kids who need some attention, and there's a bit of work to be done as well. I think we ought to call it. John, very nice to hear from you today, and we'll catch up again. Thanks very much for your time.
Thank you.
Nick, great insights, and thanks for your time today too.
Thank you.
And for everyone else, thank you for listening.